Hi. If you're running your business in a company structure, the money that you take out of the business needs to be accounted for. And it can be accounted for in a few different ways. So one of the obvious ones is you could well be an employee of your own company and you could receive wages. You could take a director's fee if you are a director of the company. If you are also a shareholder of that company, you could take dividends. Or you could take money and it could be considered a loan to be repaid. The important thing here is that whatever money you do take needs to be accounted for in one of those ways. We can't just take it out and not account for it. Now, I suppose the first thing we need to understand is that the company is a totally separate entity to yourself as the business owner. So you could wear multiple hats, as I said. You could be an employee, a director, a shareholder, but how we take the money out is going to have a significant impact on tax. Now that's tax both for you yourself personally and also the company. So if you're taking it as a salary or wage, then that's obviously a deductible expense for the company, reducing its profits and therefore tax. But obviously it's allocated to you as an individual for which tax needs to be paid for. In the company, superannuation has to also be paid, work cover, etc. Similarly for directors' fees, those same things apply. The only difference is that the pay-as-you-go withholding tax isn't paid ongoing from a director's fee. It sort of rests with the individual at the end of the year. If you're taking a dividend as a shareholder, there's no superannuation and there's no tax withholding paid on a quarterly basis. But bear in mind, dividends are paid in after-tax profits, so it's not a deduction, an expense for the company. If you're not accounting for it as a dividend, as a wage, a director's fee, then technically it's a loan, and that loan needs to be repaid. Now, it can be repaid by you physically giving the money back at some point in time. But if it is a loan, then a loan agreement needs to be drawn up between your company and yourself individually. The paying it back aspect doesn't necessarily have to mean that you physically pay it back. You may take dividends in subsequent years to pay it off over a 7-year period, therefore spreading your tax burden and effectively deferring it over a longer period of time to try and keep you out of the top tax bracket. Now, all of this is important, and it's obviously going to be different to everybody because it's going to be determinant on how much money you do take in any given year. And if you keep taking a significant amount each year, then obviously that's going to continue to increase your loan amounts and your dividends and potentially take you above and into the top tax bracket. So planning for this is very important, and making sure that you're not triggering the highest tax bracket where you can afford to. That's obviously a positive thing. Hopefully I didn't get too technical, but hopefully I gave you some insight into understanding how you can take money out of your company, how you need to account for it, what your options are, and the potential tax savings. Hope you found this useful. Thanks for listening. Look forward to speaking with you soon. Bye for now.